Hey, everybody. Today we're going to bust a common myth in real estate. Most people still have this idea that you have to have 20% of your purchase price in the bank before you can buy a house. And that's just not real. Now, there are some costs and some implications if you don't put down 20% or if you put down less than 20%, right? By any stretch of the imagination. So let's talk about that real quick. 20% down. Why the myth? Because it used to be that you had to have 20% down payment in order to qualify for a conventional mortgage. The reason is that when a mortgage company lends you money, they want to make sure they're going to get their money back. And so if they put 20% requirement on your mortgage so that you've got to come up with that money, basically the idea used to be that the only way you're going to be able to come up with 20% down payment is if you've got some financial stability. So that's kind of the history of it. Why is it a myth now and today? So first we got to talk about, what does your mortgage payment look like? All right, so a little review. So each month your mortgage payment consists of four components. You send one check to the mortgage company, but it consists of four components: principal, interest, taxes, and insurance. So principal is the balance on your loan. Some of that monthly chunk goes towards the balance on your loan. A significant amount of your monthly amount goes to pay the interest on the loan. And then the taxes and the insurance is escrowed or saved by the insurance company on your behalf. So a portion of your monthly amount, 1/12 of your annual taxes, is collected by the mortgage company every month. They put it into a savings account, and then every 6 months they send a check to your county and your state and your locality, wherever your tax bills come. And then the other piece is homeowners insurance. That's different than PMI, private mortgage insurance, which we're going to talk about in a second. So you get mortgage insurance through USAA or State Farm or Travelers or wherever you get your homeowners insurance. You pay 1/12 of your annual premium for the policy to the mortgage company. And then once a year or twice a year, depending on how the billing cycle works out, the mortgage company takes that money they've been saving for you and they pay your mortgage on your behalf. Again, this is all about risk management. They want to make sure your taxes are paid. They want to make sure your insurance is up to date, because if the house burns down or if the county comes and takes the house, really the hit is on your credit report, but the financial implications are the mortgage company's financial implications, right? They're the ones that put a couple of hundred G down on the table, depending on how much your down payment was. So how does the mortgage company get around the risk of people putting down less than 20%? And that's something called PMI. So that's private mortgage insurance. Private mortgage insurance is something that mortgage companies will require you as a lender to pay a premium for. So it's an insurance policy. It protects the mortgage company, the lender, against default. So if you walked away, if you threw your keys under the front mat, you walked away, you said, "I'm done, I'm not paying anymore, and you come find me," right? The PMI is how the mortgage company is protected against losing a couple of $100,000 or whatever the principal is on the loan. Okay, so that's what PMI is. If you put down less than 20%, you put 10% down, 5% down, you can do that. There's mortgage products out there that'll do that, but you're going to have to pay a PMI. You've got to pay the insurance premium for the lender. Okay, so when does it make sense? When does it not make sense? There's actually some programs out now with some lenders where you can put down as little as 3.5%. 3.5%. That's not a lot of money out of pocket. So let's talk about a nominal property in the Northern Virginia, DC, Maryland market. Talking about, let's say, $500,000. Okay, 3.5% is $17,500 to buy a house. Plus, you'll also have to pay closing costs. So there are other costs associated with the purchase. But as far as down payment goes, there are companies out there where you can get a loan product, and some of them don't even charge PMI for as little as 3.5% down, $17,500. That's a pretty incredible opportunity. Now, there are other costs associated with that loan, and you need to make sure that you do a really good side by side comparison. And that's why you've got great real estate agents. So no matter where you are, whether you're working with Lisa and I, or you're working with somebody else, please make sure that your realtor takes the time to mentor you through your financial options when it comes to mortgages. And the first thing they should do is bring into the conversation a really great mortgage officer. And the other thing that you want to ask your real estate agent is, what kind of relationship do you have with this mortgage officer? Because there are professional relationships where there's fiscal incentives, right? And so you want to know what's driving the recommendation. When Lisa and I recommend a professional, there is zero financial incentive whether you use them or not. It doesn't matter if it's an attorney, settlement agent, a lender, inspector, contractor. Zero financial incentive to people that we recommend, because we only recommend people that perform at the highest levels. And if they stop performing up there, they don't get recommended anymore. Alternatively, there are business arrangements, and there's nothing wrong with this. You just want to know like what's driving the recommendation. Where if you use a specific lender, the real estate agent that recommends them, or if you use a better example is if you use a specific contractor to do a job in your house, and the real estate agent recommends them and you use them, sometimes that contractor will give some money back to that real estate agent. So you just want to know where the motivation is coming from. So, myth busted. Have a great day.